Good evening, everyone. Thanks for joining in. Today we have Prashant here, who is a momentum practitioner. He trades stocks based on momentum, cash stocks. He has been practicing this since 2014-15, I guess now. Yeah, right, Prashant.
The current form I'm doing from 17 onwards. Basically, I used to be a trend for all earlier kind of thing. I used to trend for on the Nifty. So I used to trade. I've been doing that for maybe, I used to do that from around 2008, 9 onwards kind of thing, post the GFC crisis.
Right. When you left your stock broking, I guess.
No, I was still a broker kind of thing. So I used to, basically, it has been a journey kind of thing in a way of, learning new things. I started with technical analysis way back in time in around the dot-com bubble, but it was not systematic kind of thing. So I went to the systematic approach, I believe around in 6, 7, but really went in all in kind of thing from 2009 onwards. Basically, pure systematic approach to the markets.
Right. So, can you tell us about your journey? Like how you went from being an unsystematic kind of a momentum trader or whatever, like trend follower, to being a systematic trader or trend follower. So, how does this transition happen?
No, basically, I think, look, end of the day, the transition for me happened because I understand my biases kind of thing. I know where I'm not good at kind of thing. For example, like most of us who start off investing, I started off as a value growth kind of investor. But my problem was that I don't have a, what do you say? When you go get it wrong, how do you know you're wrong kind of thing? One of the advantages of systematic regarding trading, investing, whatever the way you look at, it gives you a clear binary output. You are either right or wrong. There's no middle part kind of thing saying that maybe this could be true kind of thing. So for me, it's always when you, what do you say, lose a big money or amount of money, then you start trying to figure out where I went wrong kind of thing. For me, that happened in 6, 7, 8 kind of thing. So I used to, basically build systems even before that, but was not really. I did not have the understanding that systems required of how. It's all nice to build a system, but the ability to trade a system when it's going through the tough times. That's a key question, I think, and that takes time. Being able to go through the cycle, only then you really understand. Okay, where you, what are the things that you neglected, kind of thing. What actually helped you, what did not help you. So for me, it was like, not an eye opener, but for me, it was like I could see. Even today, for example, one of the reasons I am sticking with whatever the strategy I do is because I know that regardless of what happens, as long as I stick to the strategy, everything should be fine. Kind of all is well kind of thing. Because overall, the strategy is, it's not a perfect strategy, but the strategy I think will provide me with a decent return for the kind of commitment of time and capital I do. And I have tested it. It's not like it's a single test that I've run or something that I myself have created. Kind of thing. It's not exactly a, what do you say, a black box kind of thing. There are research papers, there are multiple books on momentum investing kind of thing. So it's pretty open. The thought process, the logic is pretty open. And what I find is that it's, for me, it works because when if you talk about a company, for example, we talk about management quality. How, I don't know how to judge a management quality. I'll take a understanding of how the business will perform from here onwards to the next, say, 5 years kind of thing. I have no clue. Even my own business, I did not have a clue, let alone trying to understand other business. So I think systematic helps for guys like me who are not really, what do you say, who are wanting to be in the market but don't have the ability to take the deep calls that are necessary in discretionary when you're investing as in a discretionary investor. For example, if you want to invest, say, in a stock today, if you want to do a DCF, the basic, you have to have some amount of hypothesis, some amount of assumptions kind of thing. To build that, again, you are again basically have to have a deep understanding of that industry, how the industry may perform, and you may still turn out to be wrong. But the problem is, once you're wrong, how do you know you're wrong kind of thing? Is it just because of stock price, which was more like what Annie Duke says, so resulting kind of thing, or is it because you really felt that the industry did not achieve what you felt you would achieve? I think there's too many moving things kind of thing. My own situation was more of what for me, what moved me to a systematic was because I figured this is the way I can have the least amount of biases that impact my decision making.
So, what is systematic trading to you, Prashant? So, is it just putting some mathematical formula like, if something is above something, then buy this. If it falls below something, then sell this. Is it just a mathematical formula, or is it, or, there is something more to it?
So, I mean, systematic is basically rule based. I mean, you are basically saying was these are the set of rules which I will apply to the markets. I mean, we generally apply to the markets in the historical sense and to see whether that I mean rule has actually value. But at the end of the day, it's the backtest itself is you can I mean always alter your backtest to suit your requirements kind of thing. So the thought process for me is that does the philosophy hold water? I mean, if you are having a certain rule, why are you having a certain rule? Does it have actually add value? What is the thought process behind it? I mean, for me, it comes down to basically coming up with rules which I think adds value kind of thing, and then checking those rules to in the historical time frame to see whether it makes it made sense in the past. I mean, if it did not make sense in the past, it's unlikely to make sense in the future. So the idea of backtest is to just see whether the rules I have, I mean, not to try to optimize it, but just to check whether the rules I have has value kind of thing. For example, I mean, if you take a, I mean, if you are buy and hold investor in Nifty, for example, you can be a buy and hold for, I mean, if you are holding for 10 years, 20 years, the question is, you will get, let's assume you'll get 12% return. Now, I mean, how do you, I mean, if you want to juice up the return, the only way is to have a leverage kind of thing. But leverage can be killer because Nifty can fall down by 50% and you'll be out of capital kind of thing if you are leverage even two times, not to forget three times. So systematic helps in understanding where your fault line lines, what kind of, I mean, where you can, I mean, can you try to juice it up kind of thing. In momentum investing, for example, I mean, it's not leverage kind of thing, but I'm like trying to select, I mean, after 1,500 stocks, how do I select the best stocks? So this is one way I figured that helps me kind of thing. I mean, not the, I mean, it's not that this is the only way kind of thing. For me, it helps that figure out, okay, these are the decently good looking stock that I can pick up with the intention that if I hold it, some of them will be big winners kind of thing. Some of them will be medium, I mean, not big losers. When very rarely do I see a very big loser. So overall, as long as I can do better than Nifty, I think that works out kind of for me.
Right, Prashant. So, let's say if your backtest says 10% drawdown or 15% drawdown, what kind of surety do you have that it would be 10% or 15% drawdown? As you said, okay, yeah, continue.
Sorry, continue.
Okay, so as you said in that Nifty example, that if Nifty falls 50%, then if you are even two times levered, you go bankrupt. So in your momentum strategy, also you may want to lever it up, or even if you don't want to lever it up, if it's at, let's say, you have made up your mind for 15% drawdown and it goes to 25% drawdown, then what are you gonna do in that case, in that scenario?
So, I mean, one of the things about drawdowns, historical, is it's all part dependent kind of thing. You are looking at a certain part the market has gone through, and assuming that if it goes to a similar part in the future, I'll have certain drawdowns kind of thing. But what if the part is different? I mean, the future part is never the same as the past. I mean, it's not a repeat of the past. It's a, I mean, I think Mark Twain or something. There's a quote saying market. I mean, rhymes not time. I mean, basically doesn't repeat kind of thing. But basically, the assumption is simple. Yeah. I mean, for me, it's like if backtest shows says 20% drawdown, you should be prepared for 40% kind of thing. I mean, it's a mental preparation. Now, whether you are, if you don't think you are prepared, because that the probability is always there that you'll hit a 40% drawdown kind of thing at some point of time. Every 2x of what your what do you say backtest says. For me, in momentum, for example, I mean, look, backtest. I mean, trying to cut drawdowns has trade-offs kind of thing. I mean, nothing comes for free. If you try to cut drawdowns, you're also cutting down on your, I mean, basically returns. I mean, per se, you will have to cut down. I mean, you have to give something for another thing kind of thing. So, in my own backtest, for example, what I've seen is that momentum will not really cut down on my, what do you say, drawdowns. I mean, I'll have a drawdown of, say, I mean, 2008, momentum would have suffered a drawdown of around 50%, which was more or less close to what the market suffered. I mean, even if you 50. So it won't really help me in terms of cutting down drawdowns. But on the other hand, because of the small cap exposure, momentum has the advantage of when the markets are good. I mean, like last year, 2020, 21 kind of thing, when it was more of a small cap rally. It was not like sort of momentum work. It was small cap that worked. Any small cap fund you would have invested would have given as good return as a momentum. Only advantage of momentum is that I mean, even without me knowing that a small cap will rally, I had shifted. I mean, the portfolio had automatically shifted to the small cap stocks kind of thing. I mean, it's like way back in 2000. If you go back to 2000, you would be riding all the dot-com stocks. Once the dot-com started falling off, you would get out of dot-com and get into the best next sector. I mean, it's sector rotation at the best. The whole thing is that it works. I mean, sector rotation works without you actually trying to force it out kind of thing. It's not like you suddenly realize, boss, I mean, dot-com is very expensive. I'm wanting to move into energy or wherever it's cheaper kind of thing. It's just market itself is, I mean, the money flow is showing that stocks that are in the energy sector are moving. So I mean, the momentum will keep. I mean, it's an automatic sector shift. I mean, for example, I mean, I'll give you a personal example. In 2017, I was all long call small caps kind of thing. 2017 end market peaked out. I mean, your small cap, mid cap all peaked out kind of thing. By 2018 middle, I was in a drawdown, but not as bad as the small cap. But I had shifted, a whole portfolio had shifted from small caps, which was 80% of my portfolio, to less than 10-20% kind of thing. And the whole 80% was into large caps and quality stocks. I mean, more of what you said, the coffee can stocks I was long at that point of time. It was not, I mean, the whole process happens, I mean, the way, I mean, you are looking at stocks that are working, I mean, right now, delivering the best returns. So the point is that every time you shift, you are shifting to the current best set of stocks, not the previous best set of stocks.
Okay, Prashant, was that discretionary that you shifted or was it systematic?
Systematic. I mean, look, discretionary. Then it's like I would have got out at the end of 2018. I mean, I would not have suffered a drawdown kind of thing. Or I'll take the current market for example. Right now, I'm in a drawdown. But I was, I mean, I wrote the whole. I mean, I had posted on my blog as well. My whole 2021 returns. Well, nothing more than a small cap. I mean, I could have been the same amount in small cap and got the same amount of return, approximately same amount of return. But advantage of momentum over just buying a small cap is that now small cap is down. Small cap is down what 30%, I think, from the peak.
It is.
I'm not down 30%. I'm down less than, I mean, approximately 15%. I'm close to what the Nifty is down kind of thing. So in that sense, I mean, my portfolio has shifted much out of small caps. I still have exposure to small cap, but not as much as I was in 2021 kind of thing. Now it's more large cap oriented. So the shift out happens automatically because that's what is. I mean, look, the whole idea is stocks. When stocks start falling down, your stock is tending to lose momentum. At which point you get out of stocks. Now the replacement that comes in is something that is working. I use a filter for the stock being close to all-time high. So if the stock is close to all-time high, something is working for that stock. I mean, it may be a large cap sector, it may be pharma. I mean, maybe pharma, sector specific, it may be market cap specific kind of thing. But the whole changeover, how the roll happens is automatic kind of thing. There's no discretion of saying I want to cut down on small cap because I'm feeling uneasy kind of. Because once you start doing that, I mean, you may get it right one time, but you'll never get it right all the time kind of thing. I mean, once you get it wrong, you'll actually end up losing a lot of, I mean, basically opportunity cost would be there.
Prashant, is it similar to factor investing or what dual momentum investing that Gary Antonaki said in his book?
Close to. I mean, factor investing is basically, I mean, dividing the market into. I mean, if you would say market has gone up, the question is how much is because of what factor kind of thing, momentum, value. I mean, dual momentum is a different ball game. Dual momentum, you are basically alternating between two asset classes. I
Yeah,
mean,
yeah, but we don't have that, right? So let's say
yeah,
between two sectors or two,
no, not
take
really
large
because
cap or small cap as different
no,
asset
no, no,
classes.
no, you can't. I mean, that's tougher to do it because I mean, you can maybe test it out. Haven't done the test kind of thing, but the logic doesn't go. I mean, look, the logic in dual momentum is simple. When the Nifty is performing, be long equities. When Nifty is starting to underperform, you are be long bonds. I mean, it's a switch, 100% switch kind of thing. Here, we don't really switch. I mean, we are actually building a portfolio of stocks. It's not a single stock portfolio. So we are building a portfolio of stocks that says, okay, these are the stocks that seem at today's prices seem have the potential for the best returns. Now, which of the 30 will deliver, I don't know. I mean, end of the day, even here, Pareto principle works. Your only 20% of the stocks makes 80% of money. But which 20% I do, I mean, I have been holding, for example, Tata Lexi from maybe 1.5 year kind of thing. But I did not know. I mean, I did not know when I picked up Tata Lexi that this will be winner. The question is that winners keep on continuing in the portfolio. The losers keep dropping off kind of thing. Overall, the winners will make up for, I mean, between winning and losing, you will make up more than what you lost kind of thing because you're cutting down the losers pretty fast. I mean, once in a way, you get a stock that is down 50% from your entry price, but very rare. I mean, maybe in the last 5 years, I've seen two times, once in the Corona and once the Vakrangi kind of thing. But very, I mean, that's a rarity kind of thing. Most times you'll get I mean, you will take out a stock with a loss of, say, I mean, even purely loss driven is between 10 to 20% kind of thing. So the losses are limited. The upside is unlimited. I mean, basically like what Warren Buffett says. I mean, why he doesn't short. The downside is only the what you short. The upside is unlimited kind of thing. Same here. The good stocks that keep performing, I can keep riding as long as the ride is there. I mean, persistent or Tata Lexi, I mean, persistent I've got out, or Dixon last year kind of thing. These were great trades because they continue to have momentum for a very long time. And as long as the momentum is there, the idea is to continue. Even though fundamentally, if you were to look at, I would touch Dixon 100 times earnings for a what is basically, I mean, not even a white goods manufacturer, if you were to put it that way, because they don't have their own brand kind of thing. So, yeah, I mean, the idea is to have not allow for discretion of selection of stocks, not allow for discretion of sectors or whatever. Just buy what the market is saying is the best of the best, and hope that some of them will work. I mean, not everything will work. You will have drawdowns. You will have long. I mean, there's no. No guarantees of any such kind of thing. But the whole idea is that I've tested this for 15 years kind of thing. So I know that overall I don't risk maybe more than what the market is risking kind of thing. So if I can get better than market returns, the upside is better than the downside. I mean, downside is as good or as bad as the market. So I don't worry about that. So my focus is more on upside. If I can capture that upside, all is well kind of thing.
Prashant, so you said our backtest is path dependent, right?
Yeah.
Right. So how certain can we be that our backtest will work in the future?
No, you can't. I mean, look, one of the ways you do it is you run your daily runs through a bootstrap or a Monte Carlo kind of thing that shows you what other parts the same returns could have followed, so that you have different, sets of drawdown kind of thing, and then take a 95% or some filter and say, okay, this is the worst case that could have happened, but there's no guarantees. I mean, look, end of the day, things can happen that have never happened kind of thing. I mean, if you have read through the LTCM debacle, they had backtested for 30 years. They had not seen a expansion of what do you say, the yields. They were shorting the yield difference. Basically, they were shorting the more liquid and buying the less liquid kind of thing because the yields will always merge kind of thing. They've done 30 years of backtest, PhDs in mathematics, PhD, Nobel Prize winners. They had never seen a scenario where it expanded and expanded kind of thing to the extent that it broke their capital. So you never can be sure, which is why leverage is one of the biggest killers for most investors because it will kill at your worst possible time kind of thing, hitting you with something that is something of a black swan. All nice to say black swan and others, but finally if you're dead, it doesn't matter because tomorrow you don't have a money to play again kind of thing. So, there's no, even here, momentum, as I said, it's not the only, what do you say, solace for me is that if the market starts going bad, let's assume the market starts going bad, unless it crabs off everything in a single week, single month, like the Corona kind of thing, within a month you have a 40% drawdown. That's tough. Even then I lost, I think, around 24%. But I got out of most stocks. In Corona, I was long financials pre-Corona. I got out of literally every financial in the end of, what do you say, March,
Feb or March, yeah.
March, not a Feb. Feb was still high. Feb was still not. Pretty high. Market was still just broken a 200-day EMA kind of thing. And I lost there February kind of thing. So I got out of literally all financials. Some of it at a pretty deep losses kind of thing. Then shifted half of the portfolio went to cash because I could not find enough stocks. The other half was more in the pharma sector. At that point of time, I don't think anyone anticipated the pharma sector to be the next big trend kind of thing. But it was a very large trend. I mean, very nice, decent trend kind of thing that I was able to capture. But the point is that I mean, I've added a couple of more rules kind of thing after the corona so that I don't have to. I mean, I do a monthly rebalancing versus a weekly, which is what most people do. So one of the problems I faced was that, I mean, the whole episode have happened in say inside of a month kind of thing, and I was just, I mean, looking stupid. I mean, being a duck kind of thing, and I mean, so what I've added a couple of rules to try and extricate myself if this happens. I mean, again, with a mid-month change kind of thing. But what I feel is, I mean, what I feel looking at my own data, looking at data from US, where it's much more deeper kind of thing. You have 100-year backtest and everything. That worst case basis, you will go into cash and say 30% drawdown. Maybe, I mean, worst case basis, let's say 30%, you will lose 30% from your peak, and you will go all into cash. I mean, I don't think that's a very bad scenario per se kind of thing, because if things are really bad, then you can be in cash for a very long time before your next opportunity comes, and you have the capital that you can redeploy when the next opportunity comes, rather than hoping the stocks that I have held itself will perform in the next rally, which it never does. I mean, the financials, for example, after crapping out, most of them actually never came back. I mean, a lot of stocks have never come back to the all-time highs kind of thing. So
Even
I don't,
pre-COVID heights,
yeah,
yeah.
pre-COVID high kind of thing. I mean, your AU Bank. I mean, I was long
IndusInd
AU
Bank,
Bank. A lot of stuff
IndusInd
have
Bank,
gone through.
RBL
I mean,
Bank,
they
yeah.
have come, basically, AU Bank, for example, has come, but nothing much. I mean, literally, they have just broken. I mean, they are trading around the all-time high of March kind of thing. Relatively, for my portfolio, is way away from my March highs kind of thing. So, in that sense, I mean, basically the idea is to ride. I mean, the whole point is it's riding the winners kind of thing. Now, whether the winner is in pharma sector, IT sector, I don't really care. It's in mid cap, small cap. The only issue with small caps is that liquidity is a concern kind of thing, because you don't want to get into stocks that cannot get out kind of thing. So I try to have a filter to ensure that I have some amount of liquidity. Even then, there's no guarantees. But at least,
Prashant,
I mean,
what kind of liquidity do you look at, like average daily volume or some turnover kind of
so
thing?
I look at, I mean, I calculate the median daily turnover for each stock. So it has to be above 1 crore for the last 1 year kind of thing. The median for
So
the last 1 year.
do you think 1 crore is a sufficient amount, like
1 crore for a
on a
personal
daily
portfolio is
basis?
very good, I think. I mean, I used to do it 3 to 5 crores for when I was doing the PMS at to Capital Mind. So 1 crore for personal and 5 crores for anything. If you are managing a few crores of rupees, I think is a decent, because if you go higher, you will just eliminate all the small cap stocks, and small cap is where the real flavor of the what do you say momentum is. I mean, I mean, few large cap only will not deliver very large alpha kind of thing. It will deliver an alpha over a period of time, but it's tough. Small cap is very, I mean, it's like cherry on a cake kind of thing. You will still get a cake without a cream and a cherry kind of thing. So for me, I mean, on an individual basis, I think, I think it's more, I mean, as a DIY, it's much more efficient versus as a fund. Because at a fund, you are really constraints kind of thing. You can't really go out and deploy a crore of rupees in, say, a share India or something of that size kind of thing, because there's not enough liquidity in a lot of stocks. You can't buy, I mean, you should, I mean, unless you want to move the price, which you don't want to. I mean, if you don't want to move the price and you still want to get in, say, a crore of rupees or 2 crores of rupees, it's not, I mean, the number of stocks you can find is pretty limited. I mean, no matter how you try, and you want to get out as well, right? I mean, it's not like getting in is the only question. I mean, if you are getting in for, say, with an average tenure of saying that, boss, I'll hold it for next 3 to 5 years, it doesn't matter. If I'm saying I'll maybe hold it for only 1 month, why should I get? Slippages will actually cost me much more kind of thing. So I mean, the liquidity filter I apply is something that I felt was decent enough. Not to eliminate everything in the basket, but eliminate enough that, I mean, a stock like a Tanla would also qualify, but I would eliminate it in other ways. But overall, it eliminates stocks that are moving higher without any volumes, without any, what do you say, real trades kind of thing, just, I mean, being bumped up kind of thing. I mean, with very light volumes. I mean, I mean, a lot of stocks that can be bumped, I mean, are bumped up with very light volumes kind of thing. So I don't want those stocks, because I mean, the whole idea of momentum exit is that we are exiting when the momentum is out. Basically, stock is falling. So when the stock is falling, generally liquidity always dries up much more than when the stock is rising. So in a already low liquid, it becomes much more tougher for you to get out. And I mean, 1% slippage, 2% slippage looks not big on the paper, I mean, theory kind of thing, but it all adds up kind of thing. Because your alpha itself is not very big. I mean, you have a decent alpha, but not, I mean, it's not like you might, regardless of what market delivers, this strategy will deliver multiple times of the market kind of thing.
Right, right, yeah. 1%, 2% slippage is like extremely common. Even if you want to buy any decent small cap
Yeah.
with a decent size, 1%, 2% is kind of nothing.
Because I mean, look, if your holding period is long, it doesn't matter. I mean, I'll give 2% if you all say if I'm say willing to buy it for next 3 years. If I mean, my average holding period, for example, is 4 to 5 months kind of thing. I mean, I have stocks that are held for more than a year, but average is 4 to 5 months. 4 months then means that I don't want to. I mean, I don't want a lot of returns being eaten up by slippage itself. And if I don't want that, then I mean, the universe of stocks really reduces.
Right, right. I've given 4-5% slippage to just exit a stock, so that is painful.
No, if you look at, I mean, I was just, I mean, in Marcellus exited about in January, I believe. You look at the chart of about in January. Basically, they were having to sell at every level. I mean, so stock just kept on going down, kind of thing. Because of, I mean, it was only their selling that was pushing down the stock. After they sold, markets have
Oh
actually picked up kind of
God,
thing because
it was straight in a single line
yeah,
every day red, right?
everything is selling because I mean you have such a large quantity. Market is not willing to absorb that large quantity at that price. So
God,
I mean,
slippage.
I mean, I mean, what Warren Buffett says, kind of, I mean, I mean, most pundits acknowledge that size is a barrier. Yeah. I mean, once you, every strategy has a size limit kind of thing. You can't once you start exceeding, you become the market. I mean, if you take LTCM again, they became the market. They were so big that they became the market. Once you become the market, you are screwed because basically others will take a real. I mean, if I know that you are a big player and want to exit, I will not be a buyer. I will wait for you to exhaust your selling at whatever price you want to exhaust, and then start buying kind of thing. So that's
Right,
it.
I'm not giving you an exit.
Yeah.
Right, cool,
It's
cool.
a, it's a,
So,
it's a tricky, it's pretty tricky kind of thing. But I think some amount of, I mean, you have to take a call at some point kind of thing. You have to draw a line at some level and say, "Boss, this is okay, acceptable to me," kind of thing.
right, right. Prashant, for our audience, can you explain momentum investing in very simple terms so that they understand and may be able to practice it?
So basically, I mean, momentum investing is buying the winners, selling the losers kind of thing at a very basic level. It's just that. I mean, we are buying stocks that are going up, selling stocks that are not going up. I mean, basically, I mean, taking over stocks that are going down kind of thing. May not be going up, but may be going down kind of thing. So momentum investing is like, I mean, it's think about it as riding a boat. I mean, if you are given a boat ride, and you can go upriver or downriver. The point is which one you should choose. No one wants to go upriver because you are going against the stream. So the idea is to go with the market, go with the flow kind of thing. Whatever the market is saying, I mean, if the market is saying pharma is the best today, I would be more into the pharma because that's where the stocks are the best stocks are performance is. So momentum, I mean, there's a lot of books and articles. I myself have written a few kind of thing, but momentum at best is basically buy the winners kind of thing. I mean, you are basically not trying to. I mean, the idea is buy. Let's say put it this way: buying the all-time highs, not trying to buy the. I mean, not trying to buy stocks that are fallen down kind of thing, but just buy stocks that are all-time high. Versus and have a 20% stop loss. I think even that qualifies as momentum, though it may not be strictly systematic. But I mean, that's not. I mean, that goes generally against human nature, which is why momentum is so tough because you don't want to buy a stock that has gone up. I mean, after it has gone up quite a bit, and buy it at that price kind of thing. I mean, most everyone wants to buy when the price is falling down kind of thing. I mean, cash the falling. I mean, because you feel that it's available cheaper. But the momentum strategy is more of a reverse kind of thing. Buy expensive. I mean, sorry, buy high with the intention to sell higher kind of thing.
Right, don't buy it cheap. Right, buy
No,
expensive.
no,
Buy things
we
at a
don't,
premium.
not deep in a fundamental sense, but we don't want to buy stocks that are falling down because we don't know how long they can fall down. I mean, your S Bank fell down from $400 to $20. So we don't know what kind of, where the bottom is kind of thing because we have no understanding. I mean, look, we are basically betting on ticker symbols, if you want to put it that way kind of thing. We are not really betting on companies. We are not betting on industries or whatever kind of thing. We are just betting on some ticker symbols. If you give me, if you take out the ticker symbol also, I'll still say books. I can rank them and say, well, these are the best by 1 to 10. If you just give them number, serial number kind of thing. Because for me, it doesn't matter what the company is doing kind of thing. All of my matter is it, for one of my filters is that the stock has to be close to an all-time high. So the idea is a stock that is close to all-time high is doing something. I don't know whether it's doing right or wrong,
The
but
people are buying. Basically, people are
yeah,
buying, right?
there's some
Someone
buying
is
interest.
willing to bid the stock too high.
Yeah, there's some buying interest, and I just want to join the bandwagon kind of thing. It's like, in a way, join the herd kind of thing that is going to the new, climbing the new mountains kind of.
Right, right. So Prashant, can you give a basic, whether what does your system, what does a basic system consist of? Can you give us some pointers like it should contain an entry rule, exit rule, or some other pointers like what should be an ideal system?
I don't think there's an ideal system as such kind of
I don't
thing.
know. At least what should it consist of, or what should be there?
No,
Like,
look, you
yeah,
have to have, look, the idea is not to have too many rules because end of the day, more the rules, more the muck kind of thing. You will have a end of too many edge cases. The more rules you have, it will result in more friction kind of thing. So idea is have simple rules that make logical sense. Forget, whether it makes money or not first. The first is does it make logical sense? Does it really say, okay, this idea holds water. For example, let's take just a simple buy about 200-day moving average. It can't be a simpler system than that. So the why the 200-day, it can be 199-day, 188. It doesn't matter. 200 is not a something set in stone. The idea is have a single number, and then if you practice it, if you backtest, for example, buying about 200 days, selling below 200 on a Nifty, you will see that it will reduce your drawdown by 50% approximately, 40 to 50% kind of thing, with giving similar returns, not exit. It gives you similar returns. Basically, it allows you to be out of the market during the worst periods of the market kind of thing, and allows you to be in the market during the best periods of market. I mean, the idea has to be don't add up. I have my momentum. I have a few filters which all again result in edge cases. But the idea is to minimize as much as possible because the more the edge cases, if you are trading, for example, you don't want to have say moving. It has to be above moving average of 50, and then your RSI has to be above 40, and if you have multiple filters, you'll never get a great trade kind of thing, which is what most people think, but it's not possible. So the idea is to have rules that are simple, clean, which is something that makes logical sense. If you don't understand the system, no point trading the system because you don't know how the system operates. If you are trading a black box, it all looks nice, but you don't know why is it failing. You have to. The reason to have a system that is simple is to understand the where it can fail. The momentum system what I use, I understand where it can fail. What are the ways I can actually lose big amount of money. Then I can decide whether I want to. When those things happen, whether I want to continue or I want to shut down kind of thing because I know, okay, this is something that I should, I had expected, I knew kind of thing. If you don't know whether that system is broken or the market has changed. Why is it not working? Which was working maybe last few months, for a few years. Suddenly, why is it stopped working? So I think don't go for black boxes or systems that are even, you don't understand. Basically, you need to understand the underlying. If you are buying stock above RSI of 60, for example, you need to understand how RSI is calculated, what are the deficiencies in that, what are the advantages. Everything is pro and con kind of thing. So idea is to understand, dig into it, deeper into the system and try to understand its weakness. So that the weakness is when, look here, every system goes through its bad time. My own momentum in what I invest for my personal funds. I had a drawdown from 2018 peak. That peak was not broken till 2020 August, I believe. No, it's tough to actually stay with the system, do all the monthly changes and everything when your system actually has not made money for you for 2.5 years kind of thing. But if you don't, and in the next 1 year, it actually, the whole capital doubled kind of thing from there because the market went up and I was able to catch it rally. But the problem is, the point is that you need to have that belief, and the belief doesn't come. by, I mean, looking at a back test or looking, I mean, it's your rules, I mean, and understanding of those rules that help you go through the bad times, because the bad times will always come. It's guaranteed to come, kind of thing. I mean, your drawdowns. I mean, price drawdowns is one thing. The time drawdown is the more critical factor, because if you are underwater for say 1 year, 2 years, it's tough. It's tough on the mind, because you are basically questioning whether you are actually in the, I mean, doing something wrong or what's happening, because I mean, you are literally not making money despite making odd efforts, kind of. So, in understanding the system, I think is the critical. I mean, the rest of it falls in place. I mean, once you understand that, you know, I mean, what kind of I mean, drawdowns, what can I can, what do you say, suffer and not to panic. Again, I don't think you. I mean, we can all talk about 20% to 30% kind of thing, but only when I mean, you really dive into the water, then you really know what you can absorb and what you can't absorb, what the mind is not willing to really allow, kind of thing. So it's something that you will actually find out during the course of time. I don't think you will find out in a backtest. Backtest, it looks all nice, kind of thing. Nice, neat. Your real background drawdown can, I mean, you see it off saying, okay, okay, chalega. I mean, as long, I mean, you look at just the endpoints, kind of thing, and say, okay, this is a great CHR, so I'll do it, kind of thing. But I mean, I mean, the time is not, I mean, doesn't pass in the, I mean, in reality, like the backtest kind of thing. So that's, I mean, again, for me, it's like, I think it's important if you want. I mean, passion, being passionate about markets and understanding what are you trying to achieve, and whether that makes logical sense. I mean, I mean, if you take value investors, they bet on the business because they think that they understand the business. I mean, they track the business closely, they track the industry closely, but they are like, I mean, again, they have that belief that they understand it. I mean, the understanding is the key. You are here, we may not want to understand the business, but you want to understand the system much better than anyone can do, because no one will help you when the drawdown happens. It's your money that has gone down that lane. The question is whether you want to continue or not, because if it's because the system is broken, continuing will only mean guaranteed bankruptcy. But if it's just a, I mean, one of the possibilities that you should have expected, then it's okay. I mean, that's part and parcel. You knew it could happen. Maybe it happened way too fast because before you expected it to happen, but chalega, kind of thing. I think it should. You will be able to absorb it much more. I mean, come back to my own example, when I had that drawdown of 24% in, or not 20, 30 in Corona. So I went back to my back test. So I saw that I would have, I mean, back test would had showed I multiple sufferings of that nature. So it was like, boss, this is not unexpected. It's not like I have fallen 40% and the market is up for 10% or market is down just 10% kind of thing. Market itself is down 40. So I'm less than, I mean, down, but not as much as the market. So this is entirely acceptable, even though it hurts. I mean, losing 30% of your capital in a month is hurts badly. But it's part, I mean, as long as your mind is, I mean, mind accept that this is part and parcel of the strategy, I think that should be okay. I don't know whether I went off tangent kind of thing or hello. Ashutosh?
Hello, we are able to hear you, Prashant. Prashant, this is Sriram. Uh, I think Ashutosh has a problem at his end. I think that's the reason why you are not able to hear anything from him. Just to uh, follow up on what you were talking, and you were telling that leverage kills. I agree. Supposing we don't leverage, supposing we put up all the money, supposing we don't leverage and we have full listing. Should we avoid trading in the F&O segment, or you think that holding cash market is the best way? My point is simple. If I am in the F&O segment, momentum doesn't happen on one side only. Momentum can also be on the reversal or on the downside. Why not encash the momentum on the downside without leveraging? Supposing a lot of reliance is say about 6 lakhs or 7 lakhs, and I put 7 lakhs and I do the same thing. It's equal to my purchasing the same kind of stocks in the cash market, and liquidity in the F&O market is much better, and I think the impact cost will be much lower than in the cash market. What is your view on that?
No, I mean, look, I mean, because if I know it's not, I mean, you as you know, there's no compulsion that we need to be leverage kind of thing. We can put up the whole cash, I mean, capital in cash, and just use the margins kind of thing. The rest remains in cash kind of. But the point is that, I mean, if I know again, I mean, your slippage may be low, but you will then have multiple, what do you say, rolls kind of thing that will cost you money. I mean, every month you will change. I mean, you are basically paying the interest on money that you have not even borrowed directly, because your roll is what? I mean, the monthly roll will cost you around 0.5% kind of thing.
Correct.
So that is something that you are basically, I mean, the whole reason is someone is funding you kind of in a way, but you're not funding yourself because you are not actually using that leverage. So I would say, why bother with the F&O itself? Why not? I mean, especially, I mean, again, it comes down to look. I mean, shorting. I mean, I don't. I mean, shorting. What I've found is that it doesn't. I mean, even when I was studying, I had stopped taking shorts because shorts work. I mean, like the March of 2020, shorts work. But more, I mean, if the drift, I mean, if you look at a market drift, it's always positive. And if you have not a very short-term time frame system, the idea is to just keep riding the longs and ignore the shorts, which I found is okay. This, I mean, it does as decently as the underlying itself. I mean, less than underlying, because you cannot never match the underlying returns, but it will give you a much lower drawdowns comparatively. So, I mean, if you all actually don't want to, what do you say, leverage, and if you are comfortable not shorting, I mean, shorts will work in I mean, if you look at your shorts, it will work maybe 20% of the time or less than that kind of thing. I mean, that's really, I mean, your overall shorts will maybe make, not really make money kind of thing, but whatever money is lost, it will recover. It will not drag you down kind of thing. But it's kind of a savior in, I mean, once in a way you get that, what is it, for the March 2020, for example, you will get that big deep swings. But that after that, you will, every shot would have been loss maker kind of thing. Every shot for the next 1.5 years would have been loss maker. After that one,
Essentially, you are assuming that uh, since we are on a long-term bull market, the longs should pay us more than the shorts. That's
yeah, I mean,
understandable.
the drift is always there, right? I mean, the drift is
That,
upward. I mean, you don't have.
that's understandable, and I acceptable. There is no doubt about that. You were telling about the drawdown period can last for more than a year or so. I understand the point that you are trying to make. Uh, I'm not trying to take a view on that, but I'm just asking you a simple thing. Yeah. Uh, Across the world, I have talked to at least about 4 or 5 fund managers. Uh, what I would call them as unbiased analysts or unbiased experts on in the market, in the money market, as well as in the bond market, or even the stock market. Across the segments, I have talked to people. All of them are of the opinion that at least for the next 6 quarters, we are going to be uh, muted to downwards rather than be on the up. And in fact, some of them have exited their SPX positions, that the spider positions that they were having. They were all invested into Vanguard mutual funds. I mean ETFs. All of them they have exited, and they are now waiting for the market to bottom out. They say minimum 6 quarters. and 6 quarters means about 1.5 years. Will we all have patience for that kind of period? Is what I'm just looking at myself as an investor. So in that scenario, only I was asking you. See, what works for a bull market or what works for a bull phase, it should work for a bear phase also. Well, maybe it is 20% of the time because of what kind of bull market we are in. But why not attempt at it? Is what I'm telling. Have you got any back tested data on that? Is what I'm just
I
that's
have
all that.
I have tested. I'll share with you later, kind of thing. I have tested. I mean, basically, okay. Here's the thing. I mean, again, that's a top down. You are. I mean, the guys who are exiting with a 6 quarter thought process that market will drift down. It's kind of a top down what this analysis kind of thing. You are looking at the overall economy, broader market, and saying us, okay, markets. I think economy is heating up. So if you are looking at a recession kind of thing, overall historically the recession. I mean, a bear market has taken around 2 years kind of thing. So if we are 6 months into this, another 1.5 years to go. I mean, that's what approximately the timeline fits in, kind of. But the problem is we don't know whether that will actually happen, kind of thing. Because I mean, for example, way back in 2020, again coming out Corona, I don't think any one of us expected the market to rush upwards so fast. I mean, literally from the April onwards itself, from the very next month. The point what I'm trying to make is that I mean, I mean, again, if you, I mean, that then we are getting into the prediction zone of how the market may behave, kind of thing. My thought process is, I mean, I also come from a top-down approach, kind of thing. My own view is that this year I always felt that it will be a tough year because we have had two extraordinarily good years. But that doesn't mean that we will not have opportunities in the market in itself. I mean, you'll have, I mean, as I said, if you go back to 2015, 16, you wouldn't have opportunities in the small cap or the mid cap. Some in mid cap, but no small cap, much of opportunity in small cap. But 15, 16 were also great years for large caps. I mean, if you are a momentum investor, you would actually make money between 15 to 16, even though the broader market actually, I mean, was negative. 17 was even more better year, but even that 2 years was not really a washout year, kind of thing. To think about it as a washout year, I think is I mean, a different ballgame altogether. But I mean, again, I'm biased, kind of thing, in the sense that, look, I mean, I mean, when you have a series of, I mean, in trend following, you have series of losers, kind of thing, 6, 7, 8, kind of thing. So, I mean, it hurts. It hurts whether it makes sense to. I mean, my opinion in especially trend following is that it doesn't make sense to take a short side. I mean, be with the long side only, and it still makes. I mean, you are limited to 50% of the time or less, and you still make as much or close to that money, kind of thing. So again, I'll see whether I'll just ping Sriram on the.
So those who are joining in a little later, just to recap, the original spaces that was started by Ashutosh crashed. So we kind of resetting it. There was a few discussions going on between some of the speakers. Prashant, Ashutosh, Anish, probably getting that back in. So just we appreciate your patience. Couple of minutes, and I hope things will be back in motion.
Prashant, just taking on the point of what Sriram was asking or talking about, and again, we've had discussions around this, but since we have a different kind of audience here, um, what do you think of uh, making use of market regime filters to try and stay out of these kind of periods where sort of what's the trade-off that you see that if you like what Sriram was saying, maybe we'll not see anything for next six quarters or a year or something, or the drawdown that you went through in 1819. So what if we use some kind of market filters, or say allocate some portion to this and one portion with somewhere where we are using a market filter? What do you think of that?
I mean, in my opinion, or whatever I have tested kind of thing, you add any filter, you are basically reducing your net returns kind of thing. I mean, your top, I mean, it cuts your return. It guarantee, I mean, more or less, I have tested multiple ideas of market regime changes kind of thing. I mean, from a simple 200-day to Brett based kind of, I mean, I would look at Brett as a proxy and saying, but when Brett starts falling down, what if I get out? Because I mean, if Brett is falling, that means that the overall market is starting to tilt down kind of. So you will stay out. At the same time, I mean, the problem is that here is my problem. I mean, with market regimes kind of thing as a filter. Even after assuming let's assume that will not take too much of a hit on returns. Market regime will get you out. When you are getting out, we always are more comfortable getting out because we feel okay, market may be going down. Let's get out kind of thing. The same market regime when it gets back you in, can you get back in 100%? I mean, to give you a real example, real live example, March I got hit whacked like anything. April I got. I mean, I was. I mean, basically I had exposure to 50%, 50% in cash. By end of April, my system was saying go 100% back to equity kind of thing. I mean, just 1 month later. But by that time, we were already in a lockdown and everything. I was wondering, Brady, should I actually? I mean, I saved myself with the skin in a sense that after losing so much, and now market has actually bounced back. I mean, I believe April was up by around 12% or something. I don't remember the exact number kind of thing, but it was a very good month kind of for April. So should I actually get in at this point? I mean, 14%, 15%. If it was up 15% for a month. So, I mean, market regime helps you in a mental space at a one certain point. But a problem for me is, I mean, I have never found, not found something that would generate without a trade-off in returns. But even if I find, I'm not sure whether I could want to participate in that because I don't know whether when it asks me to get back in, I have the mental ability or the mental confidence to get back all in. If I'm trading all in, yeah, I mean, basically, it's more. I think it's more of a mental game than I mean, what I felt after that, especially the Corona drawdown, was this. It's all about mental game kind of thing. As long as I think I can sustain, I would ladder like to be true and true. I mean, better than basically getting out and hoping that market. I mean, because even market regime filters have whipsaws kind of thing. It's not like you'll have all the. I mean, you may get out. Let's assume I got out at the end of last month because at the end of last month, market had fallen quite a bit. I mean, you are lifted drawdown at cost 20% everything. So when do I mean? And let's assume I want my entry back is only when it hits the Jan high or Feb high kind of thing. At that point of time, will I be mentally prepared to get back in because I'm now actually getting back at the highs? And there's no, I mean, nothing would have changed at that point. I mean, at that point of time, nothing would have changed in the narrative sense. So for me, I mean, that getting in, getting out, I mean, then there is a slippage, everything adds up. I mean, your taxes add up because you're actually booking out on a lot of stocks that are actually yielding you money. Or you may actually say, okay, I don't want to buy stock, I'll just get out kind of thing. I've tested both variables kind of thing. I mean, for me, it was like, boss. I mean, if only if the stock I don't have a stocks to select, I would want to get out. If I have enough stocks to select, I would rather go with whatever stock there is after it has spotted all my filters. Then be in the out of the market because of the expectation that maybe the market is not really looking good. And I mean, I may be right. It's not that I may not be right, but even if I'm right, I would rather be invested than be outside and suffer kind of thing. I mean, if it suffer, I'll do. I'd rather be invested and suffer than not be invested and suffer.
Okay. Yeah, I think you're right. It's everyone's personal choice. I think Andreas Krenau has done a fantastic job in terms of doing yearly commentary. And there, if you read the commentary year by year, you will see that there is a trade-off in terms of when the market bounces back. Say right now it's bounced back from 15,000. It's not crossed any meaningful level like a 40-week or 10-month moving average, something like that I track. It's not even gone back to the 200-day ones. So it's a, yeah, you're right. It's a trade-off. What do you, if you think then you can get back all in once you're, because again it's a mental thing that if you feel that I don't want to take the pain of the drawdown, I'm okay taking a bit of a whipsaws along the way, and I will get back in when the market gets in. Get I don't get FOMO, I don't get all of that. So So it depends on what works for you. As you know, those are some of the choices that you have to make, because going sideways for a long time in 1819, that can be, that's like death by 1,000 cuts. Then or being long in a period like 2008, you go down by 50%, 60%. Even then, will you have the same point applies, right? Will you have the courage to get back in and deploy? If you started at the beginning of that year, and you started, or maybe started a year ago, and you made say 10-20%, and then you're down 60%, so you will be down say 60% from 120, so you'll be down to say 65-70%. After that, will you have the mental ability to get back in? So I think it's all to do with your mental ability and your, so people, so in fact now I tell people the other that that systematic or quant does not take the emotion out of investing or trading. It only takes the emotion, it's supposed to take the emotion out of executing. You will still undergo some pain or the other. There will be some pain, whether you take the drawdown pain or whether you take the fear of missing out pain. Some trade off you will have to make, because if you don't, there's no pain, there's no premium, there's no sustainable premium in the long run. Otherwise, everybody will just do that. So
But
you're right.
it will be a bad decision, isn't it, Anish? See, if you are doing it with your own money and for your own self, it won't be mistaken, because there is nobody else to mistake it. But if somebody had given you money and you are doing it as a kind of PMS or something like that, I think you will look like a fool. uh, Adding emotions to that and saying that, yeah, after all we are human beings, I don't think. See, it should be a hard stuff rule. Yeah, whatever happens, we should think. After all, people, I have put money in several funds. I know for sure it is risk money, and I am prepared for losing that money. That only I am putting that, because it's risk capital. Once into equity, it's risk capital. You don't look at. I mean, in one of the funds which we have invested somewhere close to about 5.5 crores, and the return up to March 2022 was, it's a pure bond fund, fixed income, 7.5 crores, 7.75 crores, and in June end we saw that to be at about 6.25, approximately 1 crore wiped off. See, it happens. We after all, we can always wish that we could have done that at that point in time. I mean, it's so easy. Hindsight is 2020. There is no way you are going to go back in your timeline and trying to rectify all these things. Accept that this is how it is, and I think that is why we do the back test. And somebody was asking how long a back test. So long as it is possible, and there is no assurance in back tests or back tests. After all, it is a test. After that, whatever happens is the reality. The reality is what is happening now, and therefore I think you should never take a decision of getting in or getting out. Whether you ought to stay in market or not, you can take a decision. Once in market, we are not supposed to use the discretion of this is corona, and therefore I don't want to go in, and therefore
No,
corona
we
will
are
take.
not talking of discretionary in or out.
Mm.
There are back-tested methodologies on market regime filters, which
No,
give you a
Prashant was talking about after corona to get in, when the whole his own indicators or his own parameters show that there
yeah,
is a momentum.
yeah. You
Uh,
have to
we
follow
we
that,
did,
absolutely.
we don't want, see that kind of situation. I think I'm totally against, and we don't know what gives the market. In 2009, everybody was talking about market going to sink. Then the market went up without any warning. I'm totally against that kind of
Yeah,
discretion inside you. You should avoid. I mean,
no,
that is
it's
one thing
not
that I.
discretionary. It's not discretionary. If you see the book by Andres Linau, the market regime filter he uses is not discretionary at all. It is very clearly laid out what that filter is, and it is completely back tested for 15 years, 20 years. So there is no discretion in I feel something and hence I'm doing something. The market regime filter is a back tested, properly defined kind of filter. There's
we
no
we all are,
discretion at all.
we all are believers that the history will be repeated.
No. It is very simple. It says that it will keep you away if you are scared of tail risk. and you are see, everybody will not have the lot of investors do not have the fortitude to take that kind of drawdown. They don't want this. They may say they want to, but most of the non full time investors who invest somewhere, because of this precise reason they withdraw at the wrong time, and which
Hmm.
results in a behavior gap.
That's not going to help.
So I agree, which is why there is a behavior gap, and which is why investors make less than what the investment fund actually makes. So it's, if you are going to save them turbulence and make that journey a little bit better by giving away 1 or 2 percentage, it's better. I'm talking about every person's behavior. Because not everybody. I mean, some people can take 60-70% drawdowns and come back, like Dun Capital or something. They've taken that. The totals could take 60-70% drawdown. Jerry Parker said, "My investors cannot take a 60% drawdown," and so he sort of reduced the heat in his system, what Ed Seykota calls heat. And he said, "I reduced the heat in my system and I made it more palatable for my investors." So that's the difference I'm talking about. I am not talking about discretionary at all. I am 100% against discretionary.
Okay.
I guess we can take questions. Anyone from the audience? Ankit, you there?
Hey, yeah, I'm there. I honestly don't have a question, but one of the things I think I also wanted to ask about tail risk that Anish already asked about, because um, quite frankly, I also spend a lot of time on using momentum as a tail risk filter or like a tail risk hedge. One of the things maybe Prashant and Anish can talk about, which is interesting, is cross sectional momentum is all about equities. So, like he was talking about small caps as an indicator, but how about if you think about momentum in a traditional sense or how it's done globally, momentum is traded cross assets like commodities and equities and bonds and FX and whatnot, right? So people who do well, let's say for Jerry Parker, they trade momentum across hundreds of names and hundreds of or tens of assets. With the landscape that we have in India, a lot many of those are not available, and then with momentum investing you don't want to be trading in futures. So what are your thoughts on using some of that kind of facility or what should I say, behavioral aspects of multi asset momentum within our Indian space, given that the choice of ETFs is limited, and of course you don't want to really be going into futures because of the tax implications. So if you have any thoughts, I would say that's a good thing to start with.
I think, I mean, you are asking the wrong person. Sriram actually does that. I mean, he has been doing that for a very long time. He does cross assets kind of thing, cross assets, cross time frames. I mean, which is what I think is the right way of doing. I mean, even Sriram has limitations because India, we don't have much of what you say, as much as US in that sense. Like what Jerry Parker says, he trades 200, I mean, he tracks 200 asset classes. So we can't do that, but well, I think what Sriram has been doing is something similar, which is actually much more worthwhile because it actually reduces your. I mean, what do you say? Instead of trading all in Nifty, which is not really possible after a certain capital amount, spread it across Nifty. I mean, your bank Nifty, your gold, whatever is available. I mean, Sriram, would you love to? I mean, would love if you could comment on it.
Well, yeah, across time frames, yes, we do, and we have presently we trade only in about 16 products. We don't not 16, about 24 products. So there it ends. We have stopped trading in gold and all, mostly because we are unable to keep awake. We are unable to keep awake and have a watch over things. So we stopped doing all kinds of these commodities, and not merely because of the late in the night business, but also because of the failure that we had in yeah, NSCL and MCX, and we felt uncomfortable placing our monies with X broker, Y broker, and all that. So we trade only in equity derivatives now. One of the main reasons why I think our Average earnings had been approximately only about 23 to 26% per annum. We don't reinvest. You know that we pay out for every year because all are family members, and therefore we have to necessarily give them the returns. And thereafter, if at all they have savings and they are capable of saving, we take it back. So our focus today is only about 24, 23, 24 products, but across time frames. We trade somewhere close to about 14 time frames, and they they yield decent results. And well, our leveraging has been very low. That is one of the reasons why we are having this 23 to 26% return. But it's all right. We are able to sleep well. Drawdowns are kept less than 10%, and therefore that's a major plus point that we have. A lot of times we go without positions. That also is all right. So that's how it is. Life is like that, but we are constantly into the business, and therefore we don't mind these kinds of situations taking place. This across the asset classes is something I believe in, but we are unable to carry it out at the present moment. Prashant.
So yeah, so in our prop book we do some cross asset trend following trading. We do gold, crude. We do some currency. We don't do bank nifty like Sriram sir. We do nifty, and we do across. We've not diversified too much right now. It's across 3 or 4 time frames. And yeah, if we had more markets, I believe there was scope for doing it for clients also. But unfortunately, the structure as well as the uh, limitations on the liquidity in some of the commodity markets, the limited ability to trade currencies and bonds. I think that sort of is an issue. I mean, you can hardly get 15 markets, 10 markets, 15 markets with enough liquidity. But so the other way to do it is like how Sriram sir does is to diversify across time frames. You can you can have a you can have a diversification across systems and a diversification across time frames. You can add some mean reverting systems. You can add some pair trading systems. You can add different time frame systems for the same instrument, same underlying instrument. So yeah, similar to that, we do some amount of that. I think it's interesting. If somebody wants to do it at the asset level, I think that's what Ashutosh asked at the beginning about dual momentum. So dual momentum is a way to do that, to do that, but that is again limited to asset classes. If you're comparing equity to gold, and then you're comparing gold to fixed income, and whichever one of the three is doing the best, you take exposure to that, and then you keep checking every month whichever one is doing well, you take exposure in that. So if that's one simple way to again do for DIY investors who are not going to trade in shorter time frames or things like that, they can explore something like a dual momentum.
Of late, Anish, I think we have started on about top 200 uh, uh, NSE to top 200, and uh, approximately invested around about 5 lakhs per product, as if it is a F&O thing. So we have invested about, it's all, we are doing it in cash. Well, we have done a back test and it gives extremely good results, but we don't know. This is almost about 6 months old. Uh, Not very bad, but I think last week or 10 days back, I was asking him. It was almost about 40%, 45% into cash. I don't know what is the present situation. I'm not very sure about it, but often we are in cash, and very rarely we are fully invested. But the promise that it holds out over the next 2 3 years is exceedingly good. I thought we will give it a try. Why not? That's what we are looking.
Which system is this? I missed out the beginning part of your comment.
Yeah, this is about taking top 200
Stocks.
NSE stocks, and we have developed a proprietary system for a specific entry and exit norms. This is not this is only end of the day. There is no other time frame that is involved. Only end of the day. So everything is prepared. Everybody gets prepared at the end of the day, and between 3:10 and 3:20, the orders get executed, and there it does. Everything is a batch order processing is done, and everything is readily available for us to enter or exit. So today's list of entry and today's list of exits will be thing, and then we will take that call at that time. So this is over a 3 year period. We have we have uh, we have found that it gives somewhere close to about 120%. So uh, we are expecting about 60 to 70%. So that roughly about 20 25%. If it gives also, it's enough. But backtest gives you 120%. But we don't mind taking at that size 60 70% over a 3 year time frame. If there is a if there are stock is inside your thing and you get a dividend, that dividend is addition to your thing. But the problem is that you may have to be paying a short-term capital gain and all that. But that we are comfortable. We are not worried about this short-term capital gain, long-term capital gain, all these headaches. We are ready to take those headaches and go with that. There we don't think that tax saving is going to help you in any manner whatsoever in optimizing your returns. That's a norm that I had. I think it's only a what you call a sales pitch for any fund manager to give. I'm very clear about that. Ultimately, the profits matter, the net returns matter, and not whatever it is. I think eventually the country will go towards 25 30% long-term capital gain. That's my understanding. So let's not bother too much about it. This tax saving should not be a way of our decision making process for taking the entry exit process.
And this is like a mean reverting system or more like a trend following?
Uh, more
Or a
like
mix
a
of.
more like a trend following only, but trend following clubbed with some other proprietary tricks which we have found to work, and everything is Excel processed. We
Okay.
process it through the Excel and then do the thing. Some one person is very adept at writing Excel programs, so he is the man who had thing. We explained to him, he did the programming, and we are able to do that.
Okay.
Ashutosh again dropped off. Huh? Ankit, if nothing is there,
No, it's quite
yeah,
fine, quite fine.
Yeah, I mean, Shad, I think Ashutosh is. Let me try inviting Ashutosh again. Uh, I'm not sure if he's having troubles with it. Otherwise, I mean, I really don't have any additional agenda.
no, we can end this kind of thing. It's been 1.5 hours.
Okay. Yeah, I think Ashutosh is having problems. Okay. All right. Maybe then, yeah, Ashutosh just joined in. Maybe
Hi, am I
can you
audible?
speak, Ashutosh? Yes, yes. Now you are. You are here.
Okay, my Twitter is acting today. I'm not sure what's happening, but it is dropping me off, and there are some glitches. I'm not sure what's happening.
You should change the phone.
It's an iPhone.
How does it matter? How does it matter? Buy iPhone 13.
It's iPhone 30. So it's the best out there. So I cannot do anything else. I guess I have Geo's internet, so it's Mota Bhai. Maybe short Reliance tomorrow.
No, actually, Ashuto, I mean, basically, Spaces is not as good as if you take Clubhouse kind of thing. Me and Anish, we have multiple sessions ported to Spaces and Clubhouse. Clubhouse, I don't think we ever faced a problem with Spaces. It's always been not just this one. I mean, Jerry Parker does it. So, what do you say? His Spaces sometimes it drops off kind of thing. I mean, still buggy kind of thing. And now that Elon Musk has pulled out, I don't think anyone wants to would go out and rectify that.
Most so capable, coders and everything, and still it's so bug. I don't know what's happening with Twitter. It's a 40-50 billion dollar company, and this is how that they get thousands of employees, whatnot.
With that kind of audio from you, Ashutosh, I think the best thing is to wind up the session.
Okay.
Okay, bye. Good night.
Hi. Am I audible? Hello?
Yeah, you're audible, ma'am.
Okay. Hi, this is the first time I'm, on this chat or space, I should say. I just wanted to know a little bit about momentum investing. Uh, I'm not much of a momentum investor, but I was wondering what would be a good app to use to get the best, ideas of momentum investing.
No, I mean, basically, I mean, the whole concept of momentum investing is, I mean, what we do is we rank stocks based upon the best momentum towards momentum. I mean, at a very basic premise, we rank all the stocks that are available in the universe, whatever universe is. If it's universe of Nifty 500, it's all the 500 stocks we rank. So, I mean, then we do a systematic saying that we'll buy the top 20 or top 30 or whatever number. But there's no, I mean, it's not a, what do you say, non-system. I mean, when we talk about momentum investing, one of the confusion is that most people assume it's a breakout kind of system wherein we are actually buying stocks based upon some short-term movements. So we are not exactly buying based on short-term movements. We are just basically build. I mean, we build a system saying that okay, these are the best stocks that are available, and buy the best stocks and hold it for n number of time. I mean, days kind of thing, maybe a week, maybe a month, and then see whether they are still the best stocks. If they are still the best stocks, we continue to hold. So generally, what happens is we have some stocks that are not the best. I mean, let's assume a stock has fallen 20% during the month. So the thought process is to remove that stock and add a stock that is doing better. I mean, we keep rolling this portfolio. Over time, the idea is we keep continuing with the winners and letting go of the losers. Or even the winners as they start losing out, kind of thing. I mean, even the winners at some point of time start losing out. So the idea is when the stock starts to lose, regardless of whether it's a winner or a loser, get out of that stock.
Yeah, the idea was I was just trying to see that how do you track a stock and check its momentum, which would be a good app to give you that indication.
So, I mean, I don't use an app. Basically, I use a software called Ami Broker. I mean, there's Abhinav here who actually has a website. I mean, if you follow him, he has a website. He actually ranks all the stocks. He's pretty helpful in doing it in the Google spreadsheet itself. So it can be done in a Google spreadsheet as well. I mean, the ranking, the building the whole application can be done in one's own Google spreadsheet. But what I do is basically I use a software called Ami Broker where I basically rank the stocks based upon the code I have written.
Okay. Okay, I get it. And you were mentioning somebody who has a website?
Abhinav,
Abhinav, he's the
yellow shirt.
yeah, he's the one in the yellow jacket, right?
Yeah, yellow jacket. I mean,
okay, I'll follow him, then I'll come to know. Okay, yeah, okay, sure. That's great. Yeah, okay. I just thought I'll know because I was using Edelweiss, the app, and they had a very good indication, the screeners, which were giving me the ones that are moving fast, the ones that are going down, And then I think they went and updated that screener, and it's now no longer as user friendly as it used to be. So I was wondering whether there was another one like that which I could use.
I mean, maybe there is. I'm not conversant kind of thing.
Okay,
Or
perhaps. Yeah. Yeah.
Screener.in also something you can use. You can just go to
Which one is that?
screener.in. Screener.in.
Yeah, screener.in. Yes, I have screener.in, but I don't get that.
You
No,
can
it's
just
not
go
that.
to the screen where they have that screening tool, and you can
Okay.
just put in that criteria screen price over the last 12 months, and just run the screen. You'll get it, and then you can just sort by the last 12-month returns.
Okay. Do they have a kind of a daily chart as well, apart from 12 months?
Yeah, I think they have daily charts, but
Oh,
for the screening part, you can screen everything and download all in an Excel file also.
okay, okay. All right. Thanks, Anish. Thanks.
Ankit, closing honors.
Ah, yeah, I mean, I think Prashant, it's always pleasure to listen to you. I hope next time around with Ashutosh not having these tech difficulties, or maybe he and I can, I host very sporadic spaces, usually very geared towards trading. So
I
maybe
know.
I'll work with him sometime on some momentum related work. Well, I personally, and a lot of people I know also do some momentum investing. Maybe not as regularly as you guys, but it's more of a back end process for us. But always a pleasure to listen to you, Anish, Sriram, Ashutosh, everybody. And I hope you all have a good night, and thank you very much. The recording for this, I hope I'll share with Ashutosh or wherever possible. I don't know if he's planning to put it up, but the space
I
recording
think
will be available.
I think it will be available kind of thing. I'll also
Yeah,
check
yeah.
out. I'm
On
sure.
on my timeline, it will anyways be available. If somebody wants, I think the more meat was discussed in the previous space, so I'll discuss with Ashutosh if he wants to do anything. But thank
Sure.
you everybody for your time, and I'm just gonna end the space now.